GM, the company, easily beat Wall Street expectations for the third quarter. Shares surging today. Let's get to Phil for more. Phil.
Tyler, they're surging because this was not just a beat on the top and the bottom line. This was a beat by a wide margin. I think they came in with earnings that were 53 cents better than the analyst consensus. And so the top line, bottom line estimates were blown away. Solid sales and strong pricing, especially in North America. That's the profit driver for GM, especially internal combustion engine vehicles. Their profit in North America up 13% compared to the third quarter of last year. And it's one reason why they lifted their EPS guidance on the lower end, brought up the lower end of what the minimum will be, also raising their 2024 profit guidance as well. Look at the stock there, up almost 10% on the day. If there is one area that people might sit there and say, I'm not real crazy about this, what's going to happen? It's China, which used to be a big profit driver for the company. Not the case anymore. Look, they lost $137 million in China in the third quarter. They are going to be restructuring their operations. They have some meetings coming up over the next several weeks, certainly sometime in the fourth quarter. But, guys, that very few people are focused on that. What they're focused on right now is the fact that General Motors, they've got it going in terms of pricing and demand, and they're in the sweet spot of the market when it comes to trucks, SUVs, et cetera.
All right, Phil, thanks very much. So let's go to Chad Morganlander and ask him what he sees on this stock. It's up 9% today. Chad, are you joining in on the rally?
Well, not likely. Let's just say that this company historically has very volatile earning streams as well as unpredictable revenues. One of the critical things about this company is that they are going to compete with Chinese automakers regarding the global on the global side over the coming not only 2 years, but 5 years and 7 years, where the pricing of sensitivity is going to be pretty extreme. So you're really in a competitive environment. The stock is up 50% year to date. We would be fading this trade.
All righty. Thank you.
Then let's move along to 3M, shall we? Those shares are trading slightly lower after reporting a better than expected third quarter. But the company's turnaround plan may not be going exactly as analysts hoped it would. Let's get to Seema Modi for the full story there. Seema?
Yeah, Kelly, the initial excitement around 3M's better than expected earnings and raised outlook is wearing off. Shares initially hit a 2-year high this morning. RBC Capital says the source of the selling is the market's assessment that the whole turnaround at 3M is much likely to be a longer grind, encompassing multiple quarters, if not a couple years. Also take note that its consumer business this quarter reported weaker than expected numbers. Now, the industrial conglomerate is going through this big turnaround, recently spinning off healthcare, embracing big cost cuts, and settling multi-billion dollars worth of lawsuits tied to toxic chemicals. That's allowed investors to slowly warm up to the name, with shares gaining almost 38% under its new CEO, Bill Brown, who came over from L3 Harris in May. Brown said on the conference call this morning that the company is exploring the sale of smaller businesses in its portfolio. About 47% of analysts have a buy rating, 11% with a sell, and the average price target at around 148. The stock currently trading at 133. Kelly.
All right, Seema, thank you very much. Chad, what's the trade here? What do you do with this one, which, as Seema mentioned, was at a 2-year high earlier today, so there has been a lot of optimism.
Right, Kelly, this is up around 30+% year to date. It is a turnaround. We would, again, stay on the sidelines with this. We are constructive on many industrials like Emerson Electric. The valuation forward-looking is P multiple of 17 times. They still have some headwinds to get through, and I do believe that the turnaround is fully reflected in the stock price at these valuations. Again, we are constructive on certain industrials. We would see that seam of opportunity within Emerson Electric.
All righty. Finally, we got the PulteGroup. The company beat third quarter estimates. Lower mortgage rates drove housing demand just a bit, but the shares are slipping today. Let's get to Diana Olick for the details. Diana.
Well, Tyler, Pulte beat on the top and bottom lines for Q3, but the stock is taking a hit, down nearly 6%, because gross margin was lower than the year before, dropping from 29.5% to 28.8%. Home closings were up 12% year over year, and revenue of $4.48 billion not only topped estimates, but was a company record. The average sale price, though, dropped to $548,000 from $549,000 in Q2, unchanged from a year ago. Pulte CEO Ryan Marshall said in the release that the Fed's recent rate cut provides a powerful tool in helping the helping to address the affordability challenge faced by today's home buyers. But mortgage rates are actually up sharply since the Fed cut rates, more than a half a percentage point, in fact, with the 30-year hitting 6.85% today. On the analyst call, CFO Bob O'Shaughnessy said third quarter margins impacted by higher incentive costs. He said, given competitive market dynamics, higher incentives were needed to help ensure we could continue to sell homes and turn our assets. There was also commentary on the recent hurricanes. Marshall said the biggest impact will be loss of construction time and power, as well as delayed inspections. Tyler.
Okay, Diana, thank you very much. Are you a constructive person on this construction company, Chad?
Well, we are on the long-term tailwinds of the housing industry in building. Due in part because housing formation continues to rise and you don't have a lot of inventory there. With that said, this stock is up close to 50% year to date. This is more of a beta play on interest rates. So as interest rates go higher, this equity price will suffer. That's the factor exposure to Pulte. I would suggest buying Home Depot as a replacement here. Less volatility, higher quality company, more durable earnings consistency with a rising dividend. So I would avoid this one and just stick with Home Depot.